There we go. Okay, so welcome Stephen Baker. He's a really bright and amazingly switched on IFA. I do love some of his pension planning. He's going to talk to us today about how he does it, what he does, and how he can help make us richer. Not that the Financial Conduct Authority will let him say that. Okay, over to you, Stephen.
Yes, good morning. Thank you, Alan. Good morning, everybody. I'm only going to speak about one particular aspect, actually, of pensions. This is not a high-tech presentation, so I'm not going to be screen sharing or sending out slides of anything of that nature, but I'm going to try and paint some pictures, so I'm reliant upon you to be able to use your imaginations on this one. I don't know how Alan wants to play this. If people want to ask questions to make it interactive, Alan, should we do that as we go along?
Yeah, put them in the chat box and then I'll read them out to you so you don't have to follow the chat box. Okay.
Okay, fine, thank you. What I'm going to speak about is something. It's a professional term. It's become known as what's called decumulation. And what the heck does that mean? Well, people spend all their time putting money into pensions with the idea of accumulating, so growing the fund, to get to a point in time when they want to start decumulating, which means they want to start taking income out. And that's a very important process because it's got to last a long time. We've got a special proposition, as you would expect me to say, where we're working in conjunction with a quality discretionary fund manager called 7IM, and it's a fully managed process, and it's all about capital preservation. Each portfolio that is built is custom built to the client's own background and the client's own requirements. How it works in simple terms is we start off by establishing a very low cost, it's called a SIP. And what the heck is a SIP, right? This is where you use your imagination. If you can imagine an empty shell, and into that shell you can place differing assets, it's very, very tax efficient, and it's also tax efficient from the point of view, it's good for mitigating inheritance tax because it's written into trust, it's outside of the estate. So a great place to have assets placed. The sort of assets you can place in there are things like pensions, ISAs, cash, investment bonds, general investment accounts. So a broad range of assets can be placed in there. It's not one of the SIPs that unfortunately have been used in the past to scam people, so you can't place property in there. So it's very, very low cost. The trick then is to sell down those assets in the correct order to create the required income. Now, I know this may sound counterintuitive. When you get to the point of retirement, almost the last place that you should be taking income from are your pension plans. And you might be sat there thinking, hang on a minute. The reason for that is pensions are, I mentioned earlier, are incredibly tax efficient. And for a lot of people, when you get to the point of retirement, pensions can be either their main asset in terms of value or the second main asset value, second usually to their own private principal residence. Because they're so tax efficient, it's worth holding that money within the pension wrapper as long as you can. What we do in conjunction with 7IM, we sell down assets in the correct order. So you might look at selling assets which are tax inefficient or poorly performing before you get to the point of selling down the pension to create the income. When it gets to the management process that we developed with 7IM, it's called bucketing. So again, I need you to use your imaginations here. If you can imagine 4 buckets or 4 pots, one bucket is cash. And in that cash pot, we will hold 2 years worth of income. So we've established what the client's income requirements are, and we'll have 2 years worth of income. The reason we have that much in the pot is we've got a year's income plus a year to recover if anything untoward should happen. Can't think of any examples, maybe something like a global pandemic. So you want to give the pot time to recover from adverse markets. We'd have a short-term bucket, a medium-term bucket, and an adventurous long-term bucket. Now that adventurous bucket is designed to create capital growth, and you can strip out the capital growth from that pot to top up the cash bucket if required. Now, each and every client will have a different view of short, medium, and long term, and that's based on their attitude to risk and capacity for loss, which we will analyze psychometrically with psychometric questionnaires, risk profile questionnaires. So again, this is tailor-made to the client's requirements. Every time we set one of these pots up, it's cash flow modeled. There are 2 tools that basically 2 tools for you use when we do cash flow modeling. One is called deterministic, and frankly, I wouldn't touch deterministic with a barge pole because it assumes a linear line, everything is standard rate of growth, standard rate of inflation, and we all know that the real world isn't like that. So what we use is what's called a, in some people, a generic term, it's Monte Carlo, it's called a stochastic cash flow model, and it runs through about 50,000 permutations. And from that, once we feed in the client data, it comes up with a probability factor. So what are the chances of you achieving the amount of income you need every month for the rest of your life? And it's worked out your life expectancy. And we cash flow model usually anywhere between 2, 3 to 5 years beyond life expectancy. Now, the information that we put into the cash flow model are income sources, which can be varied. It could be cash at bank, state pension, other sources of income that you may have, let property, whatever it may be. We do a budget planner to work out what ongoing expenditure will be. We look at potential inheritances that you're going to receive, or the client is going to receive rather. I mentioned earlier, works out anticipated life expectancy. Somebody may be doing this when they're 50, believe it or not, we'll do the cash flow early, and then so we'll build into them we do a forecast on their state pension, and we'll build that into the cash flow model. So your state pension won't kick in till you're 67, and it's going to be £176 a week, or whatever it may be. The client's objectives may vary. Some clients are just simply focused on income. I want to maintain my income for the rest of my life. Some people want capital preservation because it's called legacy planning. There are people out there that want to leave a lump sum to nearest and dearest should they shuffle off this mortal coil. Some want a mixture of the two. So again, I want you to imagine a triangle, a pyramid of income. The base stone of that pyramid is what we call a minimum income requirement. So that could be things like, I spend £600 a month on food, I need £600 a month for the mortgage, or whatever it is. This is essential expenditure. So we make sure we cover that. The next layer above that is nice to haves. So you've got your basics, and it would be nice if I could also have whatever it may be. The next layer is what's called discretionary spending, and that may be things like capital expenditure projects. So you may need a new car, you may want to go on a Caribbean cruise. And at the top of that pyramid is what's termed, I'll use the term earlier, legacy planning. It's a lump sum of money you'd hope will be left at the back end, so you can leave it in trust for your spouse, your children, grandchildren, whatever that may be. Now, the trick with the cash flow model tool, and this is where financial advisors make a big mistake, even if they do this, often they'll only do it once with clients, which is frankly pointless. When we sign clients up to this particular proposition, we do the cash flow model every year. The reason we do it every year is because circumstances change. The sort of changes you can see, income needs may change for whatever reason. People become less physically active as they get older. Expenditure may change. Strangely enough, in many cases, expenditure can increase rather than decrease. There may be capital expenditure needs. It could be that if your health has changed, you may need to make changes to your house, or whatever it may be. You may need lumps of money to spend on large capital expenditure projects. Your attitude to risk, your capacity for loss may have changed on an annual basis. You may have unexpectedly inherited some money. And the other important point is your health may have changed. If your health has changed, it puts a whole different perspective on retirement planning, because suddenly if we have to buy guaranteed income, what's called an annuity, you can get something called an impaired life annuity, and that can increase the value of the annuity by anywhere up to 30 to 40% because it's underwritten where life expectancy, sadly for many people, is reduced. So what I've done there is I've skipped through what is a very, very complex proposition, but it's not complex from the client's point of view. It's simple for them. They simply sit back and the rest of the work is done in the background between ourselves and 7IM, and we just make sure we match our proposition to their requirements and make sure that on an ongoing basis it continues to work for them. I don't really need to say much more about the proposition, Alan. I hope that
That's been really useful. Yeah, that's very good. Speaking as a qualified IFA, I did love that. So well done. Any questions?
Stunned silence, Alan. Stunned them into silence.
Just a comment. I remember once visiting someone who was using an algorithm like that, and it caused a financial conduct authority to go into a complete meltdown. Have they gone into meltdown with you, Stephen?
No. This has all been approved. This cash flow model has been worked out. It's approved by the FCA, and it's actually 7IM, the huge fund management group. It's not a generic one they're using. It's their own custom built. They've spent a lot of money putting this together, so it's a custom built software package.
Okay, brilliant. Okay, Fiona, you had a question.
Oh.
No, it was just applause in appreciation for what you've shared. Thank you, Stephen.
Yeah, don't applaud, Fiona, just throw money.
Okay, coins, virtual
Damage
coins.
my screen, I wouldn't dream of it.
Lovely. Harry.
I noticed at the beginning you talked about trusts being outside of IHT.
Yes.
Inheritance tax. And I just wondered if you could explain a bit more about that.
Yeah, it's quite a complex area, inheritance tax on pensions, but basically what you do is at the outset of writing the pension, you put it into a discretionary trust, as it's called. Now the beauty of that is HMRC can never come back and argue with you that you had access to those funds, because in theory you've given ownership of that to trustees, so it's them that make the decisions on the distribution of the money at the back end should you die. What you complete is an expression of wishes. You direct the trustees as to where you want that money to be paid, but it puts the money outside of the estate. Without getting too technical, if you die before age 75, any money that you leave for beneficiaries from a pension is tax-free in terms of income tax. It's taxable if you're leaving assets to somebody beyond the age of 75, but it's not chargeable to inheritance tax unless there's one little loophole. How you can be caught for inheritance tax is if the benefits are not paid out within 2 years of the trustees being informed of the death of the pension member.
Okay, any other questions?
Does that make sense?
Harry, did that answer your question?
Can't hear. Can't hear, Harry.
If you could unmute, Harry. What you're saying is brilliant, but
No, it was pearls of wisdom lost forever.
right.
Okay, in simple terms, pensions written into trust, it's outside of the estate. In theory, there's no inheritance tax on the death benefits of that, but it's just important that people have engaged with a good financial advisor. But no inheritance tax written into trust. One of the most valuable assets that you'll have, keep it there, sell down cash, ISAs, general investment accounts before a pension. It's valuable.
As if everybody should.
Sorry, I missed that, Harry.
It sounds as though everybody should have a trust, and you're simply left with the problem of what to do with the house.
Yeah, again, it's a whole different subject. Trust. There can be problems with trusts as well. You've got to be careful how you write them. I mean, some of them have periodic and exit charges. So trusts are very complex. But in the main, most things should be put in. Certainly, life assurance policies should be put into trust.
I was going to say
85% of them written in the UK are not put into trust, and they absolutely should be.
that's criminal, isn't it? So because if you drop dead, Harry, not that we wish that on you, but your life insurance, if it's not in trust, gets tied up in all the probate, where if it is in trust, then it's a lot easier, isn't it? So
yeah, dead right.
So, okay, Fiona, you had a question.
Question before Harriet had a question before me.
He's done his, so
Okay.
Yeah.
So mine is a general question, Stephen. Just interested, obviously, without any breakage of confidentiality. What have you seen in the last year in terms of either people passing away that have been clients of yours where they would have been predicted to have lived several more years, and in terms of what you are predicting for the next year, because everything is so uncertain? Has there been anything trends that you've seen?
We have had a couple of clients pass away, but I wouldn't say it was well. We see everything from this side of the fence, unfortunately. We had a very unexpected client pass away because it was very sad. I'm not making light of it, but he hung himself. He committed suicide, leaving 2 young children and a wife and a brand new house and mortgage, which I arranged for them. So that was very unexpected. I have had another couple of clients pass away. And again, clients don't often see the benefit of what we do until that happens. Ted will know the amount of support and help you can give when there's been a death in a family. What I've seen over the last year is an incredible amount of volatility in markets. We've had clients panicking and contacting us and saying, should I cash my investments in, which is exactly the wrong thing to do, because you then crystallize the loss. Up until that point, it's a paper loss. And in fact, some clients have taken our advice and started to put regular premiums back into investments, because that way you benefit from something called pound cost averaging. Volatility is not your enemy, it's your friend, but you've got to be able to ride out the storm and take a medium to long-term view. I would say that we've had a good bounce on the markets in the last quarter. The funds are back to at least equilibrium, if not higher than before the fall. But there is a lot of volatility moving forward. And I don't want to be pessimistic, but I do see problems around March of next year when things start to unravel properly from this pandemic and the cost of it. And I think, without wishing to sound conceited, I think economists haven't priced in the cost of the pandemic properly into what's called PE ratios. And I think there's still some pain to be felt, I'm afraid.
What are PE ratios?
Price earnings. So when you look at the share price, there's a price earnings ratio. And haven't priced in the cost of that properly, and I think we will see harder times on the markets.
Thank you.
Okay, that's brilliant, lovely. Thanks for the question, Fiona. Right, how are we doing time-wise? Right, we probably ought to go into breakout rooms because we've got time for 2 breakout rooms. Okay.
Alan, sorry to interrupt you. Could I say there are a few hands up, and I know we can't take it time. If people want to message me, I'm happy to respond after this is all wound up today, if needs be.
Or perhaps at the end, if people want to come in and do a clinic with you, that's fine. So we could do that.
Absolutely. Okay. Thank you.
Okay. Yeah. Okay. Lovely. I'm going to stop recording now.